This video is a MEXC futures trading tutorial. We're going to go through the entire system right here, how to navigate it and how to place orders on this system. And within this video, a leverage trading tutorial, how to think about leverage, how to use it responsibly if you want to use it at all. Timestamps for everything down below. We'll come to the MEXC Global main page first though, and we'll look at getting fiat and cryptocurrency on and off the platform if you do want to trade. So I'll leave a link to MEXC down in the description. They give deposit and trading bonuses when you sign up, so you can check the details via that link. There's also a beginner's guide to MEXC linked down in the description, a step-by-step on getting set up on the platform if you need to see that. For buying crypto though, as we can see, a global bank transfer is one of the options. This is going to depend where you live in the world if this is supported or not, so you'll have to check wherever you live. But as we can see here, bank transfer, you can actually transfer in euros on this occasion or GBP, and that goes through to MEXC bank account via a SEPA transfer. So what you can do is tell them how much or how many euros that you're going to deposit, and they will obviously switch that into USDC or USDT as your choice. Most futures are traded against US dollar tether, just as a guide there. So most people will transfer into US dollar tether instead of USDC, but that's up to you. You'll have to check the trading pair if it's supported with USDC, if you want that one, and then go ahead and click buy now. Now what you can do is get MEXC's bank details and send a bank transfer into them via euros via your banking app. Now the other option is a debit or credit card if you don't have the bank transfer option. So what this does is just a simple Visa or MasterCard payment right here, and you can use one of these currencies, and then it goes into US dollar tether, as you can see again, or USDC. Now the difference here is the cost. You can see the reference price. There is going to be a cost here from the payment processors that are used. Usually it's around 2 to 3%, whereas a bank transfer is essentially just that payment from your bank account. So cards are more expensive to use, and that goes across all trading platforms, but that is fiat currencies. Now if you're looking for cryptocurrencies to actually deposit in, that's easy as well. If you've got crypto on a different platform that you want to deposit into MEXC, go into your wallet. So top right hand corner, you can click wallet and overview. Then you just have to go to the deposit option. If you scroll down here, you can see your wallet overview. This is your spot wallet, but you can transfer things into other wallets as well. So click deposit here, and then it's going to go through to the option to select a crypto to deposit. So we'll choose any of these. I'm going to choose US dollar tether. That's what I have on other platforms. So network right here, you're going to have to choose a network that's supported on both. So what we can do is go over to a different platform. So I'm going to show you my Binance here. I'm going to withdraw US dollar tether. It says that the TRX network is suspended right now. So what I want to do is make sure that we can choose the same network on both ends. We've got Binance Smart Chain as an option as well. Go over to MEXC. Binance Smart Chain, as you can see, is an option. This is a cheap network just to transfer in between exchanges. So we'll choose BEP20, and it says click to generate address, so I can do that. And that's going to generate my US dollar tether address on the BEP20 Binance Smart Chain network, or the BNB Smart Chain. So I'm going to copy this address right here and then go over to my Binance and make sure I choose the same network. So BNB Smart Chain right here. You have to make sure that if you're transferring from one exchange to another, the address is on the same network. Otherwise it might get a bit funny. So I'm going to paste this in right here and choose the BNB Smart Chain. Press yes, I'm sure. And that address is my MEXC address. So I'm going to be sending from the BNB Smart Chain here, and double check that you are receiving on the BNB Smart Chain on the MEXC side, and just go through with that withdrawal from your other exchange. And then that's going to go through into your MEXC Global spot trading wallet. If you want to trade futures on MEXC, you need assets in that account. So it's separate from all the other accounts. So come back to your wallets again and overview. So the spot account is where you buy and hold crypto. That's the crypto that you own fundamentally, and you can withdraw it from the platform. Futures is obviously the futures trading platform. You can't withdraw directly from there. So we can transfer assets from spot over to futures. So come to transfer here, then you can choose any account and then to any account. So there are many different accounts depending on what you want to trade. So we're going to transfer in some assets from spot into futures. So we'll just press all here and then press transfer. That's an internal transfer, so that's not going to cost anything, and it's just immediate. It just shuffles the assets from your spot into your futures account. And of course you can reverse that if you have some profits from futures and you want to take it out to spot and then withdraw. You just switch that around and transfer it from futures back into spot. Before we get into the futures trading platform, MEXC actually do offer a demo trading feature as well, which I think is really great for beginners. If you go to futures and then demo trading here, this allows you to trade in a real environment without real funds. And so it's a complete kind of copy paste of the real live market. You have live price feeds. Everything is exactly the same, and you can practice out your trading. So if you are a beginner and you're worried about inputting orders incorrectly or how to use this system, then you can use the demo trading feature, but we'll be going through the live market right here. If you come down, there should be an option here to receive demo coins, as you can see. So I've got 5 in my balance here. If I click receive demo coins, you can choose an amount of the coins to receive, and then you can actually practice trading with real funds here. These are obviously all demo coins. Any profit and losses are just on paper, but that is great for beginners to practice. We'll be going over the live market though. There are 2 types of futures contracts you can trade on MEXC and in crypto generally. They are called dollar margined and coin margined. So unlike the spot market where you buy and hold crypto and it's actually yours and you can withdraw it, with crypto futures, you are just taking positions on the price. And so a crypto futures platform is known as a derivative, where what you're trading here is the price of crypto rather than the crypto itself. And so the way that futures works is that you put an amount of capital onto the futures trading system and you use that as collateral for your trades. Now, the money that you put on is collateral to pay any potential losses. That's pretty much it. So we can use leverage as well with futures, which I'll get onto later. But firstly, the collateral that we use on futures is either US dollar or coin, which is obviously a crypto. So if you come to the futures trading platform here, just click on futures, you can see there's 2 options. You have USDT-M and Coin-M. So USDT-M is US dollar margin. So you're taking a stable coin, in this case US dollar tether, and you're using that value to margin the trades that you're putting in. Now, a lot of people use US dollar margined because USD is not a risk asset, and it's obviously the thing that's used to price everything else. And so that dollars are obviously always there at a certain price. You can put dollars on, you've got $1,000 worth, and you can use that to trade with and take risk positions in the risk assets. So what we can do here is come down. You can see all of the USDT margin futures right here, Bitcoin, ETH. You can see all of these other ones that you can choose. You can make them favorites as well, and then go to favorites if you have any. Now that's US dollar tether margin. So if you want to trade that, of course, you do need to put US dollar tether into your account. Down here, you can see all of your balances. So I've got the wallet balance here. Total equity, this is your balance plus minus your profit and loss. So whatever that is, that will be your total equity. Now, of course, if you've got $1,000 on the account and you're making a big loss, your equity may be going down further. And of course, the system will never let you have a bad debt, or at least it shouldn't do. And so what happens is, if your account equity gets below a certain threshold, it will start essentially not allowing you to trade and even start liquidating your positions. That's absolutely what we don't want. And so when we trade, we need to make sure that we don't ever get into that situation and we take losses early, which I'll go through with stop losses when we trade. But the available margin you can see here is the amount that you now have to actually trade with. When you've got running trades open, depending on if you're making a profit or a loss, this available margin may be higher or lower. It depends on your account equity at the time. What you put in initially isn't what you actually have as account equity later. So if you want to deposit or transfer assets from your accounts, you can actually do it directly in here. As you can see, make a deposit, or you can press transfer here. And if you've got some assets in your spot account, you can very easily transfer them over. So that's USDT margin. Most people will trade USDT margin simply because it's easier to trade, because they know that the crypto asset is valued in those dollars. Now, coin margin is when you actually put a crypto asset onto the platform as your collateral. So we go to Coin-M here, you can see this should change, and you can actually just change the trading pair very easily. But now what we have is the coin margined assets. So we can go over to Coin-M, and now you can see BTC, USD, ETH. There's far fewer that you can use as collateral. So most people will trade the bigger two, ETH and BTC. So on this occasion, what we're doing is we're actually transferring in the crypto asset as collateral to trade with. So you'd come to deposit here or transfer, and you would put BTC in. Now, the benefit of this is if you have a lot of BTC, it may just be easier for you to trade with that. Usually, if you're very bullish on the price, you may put coin margined in because you're putting BTC in, and that's the collateral for your account. So it's much more risky when you put coin margined in, because if you put Bitcoin in and then you take a long position on Bitcoin, you're now very ultra long Bitcoin, because the position is long, especially if you're using leverage, and the coin is the value of the collateral that you're using. So if the price moves against you, not only is your position in a loss, but your collateral is now losing value as well. And so it definitely can be more risky. And so coin margin is really used if people definitely are bullish on the price and they want to kind of leverage up the assets that they already have, because you may have already bought Bitcoin and you're bullish on it short term as well, hence the futures position, rather than having to sell it for dollars to then margin up. So people can use coin margin usually on the bullish side. Most people though, if they're just putting assets in and they're looking to take a long or short position on the price of something, they might use US dollar tether margin. Here are MEXC trading fees as of making this video. For maker orders, 0%, and for taker orders, 0.018%. You can also get a discount extra if you pay fees in the MX token. You would have to buy some MX token on the app itself and then use that to pay for fees. It's a risk asset. It can go up and down way more than 10%. So it's up to the individual whether they would want to do that. What are maker and taker orders, and why is it free to actually trade these maker orders? Well, maker and taker refers to who you are as a trader, and the liquidity that you put on the order book. So as you can see, this is the order book right here, and there are two types of trader right here. So you can see all of the orders right now that are actually already on the book. Well, if you use limit orders, you can actually make liquidity. So this is where we can see the price is trading at 28,000. If I put a limit order on and say I want to buy at 27,500, I can put that limit order on the system and it's going to come down here on the order book. I am making liquidity because I'm putting my order onto the book that is away from the current price, and it's not going to trade right now. And so I'm making liquidity by putting that order on the book that other people can come and trade. Now, if I take liquidity, I use a market order and I just say, buy me $100 worth or whatever it is. And I take someone else's order here because I'm not putting a limit order on the book. I'm not creating liquidity. I'm actually taking liquidity away from it. So as you can see, most trading platforms will incentivize maker orders. That is, people putting limit orders on the book, making liquidity, making orders, and they disincentivize or at least just charge you fees on the taker orders because they want liquidity. So that's how maker and taker works. If you're using limit orders and trading away from the current price, that is a maker order. If you're using a market order or just trading straight away, taking someone else's order, that is a taker order, and you get charged those trading fees. Something else to be aware of when trading futures is the funding rate. A funding is unique to crypto futures in that it tries to balance buyers and sellers on the platform, or long traders and short sellers, to keep the price of this in line with the underlying asset, because this is a derivatives price. And so this isn't the underlying spot market price, but the system tries to keep this price of the futures contract in line with the underlying. And the way it does that is through the funding rate. It's basically an incentive or disincentive to try and attract either longs or shorts into the market to bring the price back in line with the futures or the underlying spot price. So here's what you need to know. If the funding rate is positive, that means longs are paying shorts. So if you've got a long position, you will be paying this funding rate to short sellers. If this is negative, then short sellers are paying that funding to long positions. Here's a breakdown of that. If the funding rate is positive here, so that means the futures is trading above the spot. It doesn't matter what the price is. There's just a spread between the spot and the futures. If it's above, then that's a positive funding, and a long position will be paying this funding to short sellers. If the funding is negative, that is the futures price is underneath the spot price. Again, it doesn't matter the actual price, it just matters the spread between the spot price and the futures price. If it's negative, short sellers will pay longs. And so you have to factor that into your trade. On MEXC, this funding rate is paid once every 8 hours. And the funding rate can change to positive or negative depending on the price. And so it's kind of unpredictable, but you want to see what this funding is. So as we can see here, the funding rate is 0.0029. And this is paid every 8 hours. So we're going to times that by 3 to get a day rate, and then times that by 365. You're looking at about 3 or something percent right now. So it's not going to make any difference to your trade. But if you're in a trade for a long time, this can change. So this might be 3% now, but if the market gets very bullish and the crypto price goes way above the spot price, that funding rate could get more expensive. And so that's something to factor into your trades. It can be anywhere usually between about 5 and 10%. And so if you're in trades for a few days or months, it kind of doesn't matter, but it's something to be aware of either way. When trading crypto futures, we can, of course, use leverage. And so here's an explanation of that. We can use either cross or isolated leverage. If you come up to the top here, you can see the leverage on both long and short positions. So you can change this around. What is isolated versus cross? As you can see here, isolated just means that the collateral that you're using to fund a futures position is isolated to that position. So you have a Bitcoin position funded with US dollar tether, you'll put some collateral towards that. Now, if you have an ETH position, you'll have to put collateral towards that position separately. That means that the two positions are separated out. If one of them goes south and you lose money, the other one's unaffected. If you use cross margin, that means you have a certain amount of assets on the platform that have a certain value, and all of that value is used as collateral to fund all of your different positions. Now, this is considered slightly more risky because potentially one position goes bad and then it kind of worries the other positions that you have. And so a lot of people use isolated margin. It's kind of the more popular option here, where each position is funded separately. So that's what you can choose, either cross or isolated, and then the amount of leverage. So you can choose that on the you can choose that on the long side, as you can see here, and the short side. So you can have this as just a default, where your default position would be 3x or 5x leverage or something like that. So here's how leverage works. I cannot recommend leverage. It's obviously very risky, and I'll show you this right now with leverage. So the way that leverage works is you put an amount of assets on the platform to fund your positions, and you have that collateral there. And as I said before, this is just to fund losses. So the system lets you trade because you have some assets there to fund potential losses. So let's say you put $1,000 on the platform. If you went ahead and bought Bitcoin with $1,000 in the spot market, that's $1,000. That's it. You own it, nothing else. But of course, with crypto futures, you can trade with leverage. So the first option to use 3x leverage is just to take your $1,000 and turn it into a $3,000 trade, right? And then you're using that $1,000 to fund any potential losses. You can see with the leverage down here is that if you're using no leverage, then obviously of $1,000, a 10% move would be 100, 20% would be 200, 30% would be 300. If you're leveraging up 3 times, you're now making percentage moves on this leverage position, which is now 3,000, because the system let you open that position, a $3,000 position now, knowing that you've got $1,000 to fund any potential losses. But you can see here that a 10% move on 3,000 is 300. Well, that's like a 30% move on your original. 20% move is like a 60% move on your original. A 30% move is like a 90% move on your original. So you can see here that if you leverage up 3x, it's about a 33% move to the downside, and you're completely wiped out on your trade. So obviously to the upside as well, that works. If a 20% move comes in on the 3,000, you're now making $600, which is obviously a 60% move on your original. So just to show here that leverage just makes wins and losses faster and more. And so that's up to the individual to understand that and obviously take their trades with the amount of risk that they're comfortable with. Now, the other way to use leverage, which is the more professional method really, is to not actually just leverage up your positions. You can do that with maybe 1 or 2x leverage. The other way is to, obviously, if you have a larger portfolio, is to use these crypto positions around the edges of your portfolio to express what you want to do without having to put a ton of capital into the system. So instead of saying I've got 3x leverage, so I'm going to take my whole account balance and just leverage it up and make it bigger, what you can say is I want to still trade $1,000, but I'm going to use leverage the other way around to actually just put less money down. So I can have this $1,000 position, but I only need $333 to fund that $1,000 position, and the other $666 I can use elsewhere. For example, if you're trading ETH pays a yield, and so you may want to just have the assets in your account earning that yield whilst expressing your trade on the futures platform, but you don't want to put the whole lot in. This is also safer as well because you just have less of your money on a centralized platform, which is also good. So that's how leverage trading works. It can either make your wins and losses bigger, or you can use it more professionally to just put less money down, but still get the trade size that you want to use. MEXC allows us to input different order types. The first one I'll look at is post-only orders. So we'll go over market. You know, a market order is when you choose the amount that you trade, but not the price. Limit order is where you choose the price right here and the amount. Now with maker and taker orders, limit orders allow us to get maker fees. If we put in a bid of 27,000 below the current price and we get hit, we've made that liquidity, and then someone's taken our liquidity, we get the maker fees. If I put a buy order in at 30,000 though, my price is above here, and so I'll actually be taking someone else's liquidity off the books, and so I'll be paying those taker fees. What you can do is go over to a trigger, go over to a post-only order, which is this one, and if your order is above the current price, right? So if you're going to input a taker order, it will actually cancel that order out. It will only post only, right? So if you're using a limit order that is making liquidity, it will allow that to go onto the book. If you're posting a limit order, which is actually going to take liquidity, it won't let you do it and cancel off. So it just kind of guarantees you getting maker fees instead of taker fees. Although when trading, it's kind of irrelevant because the fees are so low anyway, but that is an option. MEXC also allows us to input trigger orders. You'll know these as stop orders or stop limit orders if you traded on different systems. Press trigger here. We'll look at trigger first. A trigger order is, or a stop order, is a trigger price where the underlying order actually then gets input into the system. So with limit orders, you're inputting an order with details. With a trigger order, you're saying, I'll put in a limit order, but only when a certain trigger price is met. Now, this is usually used for stop losses where you can't input a limit order. So I'll show you that as a detail. Let's say we're long at 30,000 and we want to stop our losses at 25,000. Now, if you put a limit order to sell at 25,000, the system is going to sell you out straight away. If I put a sell order in here at 25K, the price is now 27, 28, and it's going to say, well, your limit price is 25, the current price is 28, I'm getting you a better deal, and so I'm going to sell out now. That's not what you want as a stop loss. With a stop loss, you want to only trigger an order when the price meets a certain level and then sell out. So this is how that looks. If the price is trading at 98 right now in the market, and you want to stop a loss at 96, you can't input a limit order because the limit order would go in at 96 and the price is 98, it would trade immediately for you. So that's why you need a stop order at 96 to trigger the sell at that price. So again, on the stop loss, if you were using it as that, trigger price is 25, you can put a limit price of 25, you can put that as the same thing, or you can just put a market order in here, and then the amount that you want to trade out of. So that would be a stop order. Only at 25 would that order be triggered. That's mostly used for stop losses, but you can also use it for take profits or breakout trades as well. So if the trigger was 30K, you could put a limit order in at 29,500 and say, when the price hits 30K, I want to go long at 29,500. So if the price was still at 30, you actually wouldn't trade. Only when it gets down to 29,500 would you input a long order. Or you can put that at the same price, 30,000. When the trigger price is hit, then you buy at that price or a market order, and then that order goes through. Why would you want to buy a higher price than the current price? Maybe you're trading a breakout. You don't want to actually trade until the breakout occurs. You want to put an order in. And so that's what stop orders are for, or trigger orders are for, just to trigger an order at a certain price. You can also put trailing stop orders in on MEXC. A trailing stop is where you can essentially choose a take profit order that is going to be a spread away from your entry price. Let's say you go long at 28,000. You can say, I want the stop to be a certain percentage below that. This is how a stop works, or a trailing stop works. So you have an entry price of something, and you can say, I want the callback rate to be 5% away from my entry price. So what happens is, when the price moves up, the trailing stop will always move up at 5% spread from your price. However, when the price moves down, the trailing stop doesn't move down. So this is essentially a way to like lock in profits, follow the price up, but don't follow it down. And so that 5% spread is always there. You can see the price increases a little bit. The callback rate will always be 5% away. However, as the price comes down, you can see this trailing stop does not move down. A trailing stop moves up and never down with the price. So you can follow up but not down. And then we can see the price moves up again. That callback rate is still 5% to the upside. Price moves down again. The callback rate does not move. The trailing stop actually sells you out right there. So that may not be a profit, but it will be 5% away. So this is how you put that in. You can go to a trailing stop, as you can see here, and you can either use a ratio or a price distance. It's up for you. A ratio would just be a percent away. So you can say, I want to be 5% away from the price, and the quantity, let's say you put $1,000 as an order in, you want to sell out $1,000. Just make sure that the amount of crypto that you trade, you sell out of if you want to sell out of the whole piece. Now, what this does is enter a sell order or an order that gets you out of that position, depends if you're long or short, 5% away. And so to the upside on a long position, it's going to move up with the price, but never down. And on the short side, if you're selling short, hoping to buy back lower, it's going to move down 5%, but never up. And so you can have that as a trading stop. This is often used when you're in a kind of profit already, and you maybe want to just get out of the position, but you can actually say, well, maybe there'll be some extra upside. So I'm just going to sell out maybe at 3%, whatever it is for the crypto that you want to trade, how volatile it is, and then say, I'm happy to take 3% lower than current price. And if it does move up, then I may make a few more percent. So it's up to you whether to use a trading stop, but they are used to essentially kind of lock in profits, move up with the price, and lock in profits if it does move back down through that level. Before entering orders on the system, we can look at the trade calculator on MEXC, especially if you're using leverage. This is an invaluable tool. It's just up here, this calculator. And the thing that's important is the liquidation price methodology. So whenever you're trading, especially with leverage, really you want to be sure that your stop loss and the area where you get out of the trade is way above the liquidation price. If you're getting liquidated, you're going to be paying some liquidation penalties, liquidation fees, and the trade's gone really wrong if you get liquidated. It's not good. So we want to make sure that the liquidation price is well within our risk tolerance. So you can use the liquidation price calculator here. Let's say we get into a long position at 27,960. So we'll do that, 27,960. And the futures quantity, which traded $100 worth. So we're going to go to zero leverage here, which is 1x. Calculate, you see the liquidation price is $100 for BTC. So obviously way below, if the price gets to 100, you'll get liquidated, but anything above that, you're absolutely fine because you're not using any leverage. Now, if I just switch this up to 20x leverage, you can see that liquidation price goes up to 26,673. If the price of Bitcoin gets to this, so it falls another $1,400, something like that, you'll be liquidated out of your position. So you need to make sure that your stop loss in your trade is above this level. And if it isn't, you're using too much leverage. So we can come down to maybe 5 or 10x. You can see that this liquidation price will get further away. So if I click calculate again, 25,000. If we use 5x, you can see the liquidation price is now 22,000, getting further away. Less leverage that you use, the more space that you have for the price to move, because the collateral that you have has more breathing room to fund all of those price movements and losses before you get liquidated. You can do that on the long side and the short side. It's absolutely vital that you have this in your mind before trading, so you know where your stop loss is and your take profit is, if it's above or below the liquidation price, if you're using too much leverage. Now we'll look at the support and resistance method for trading, and also how to size your trades appropriately to take the right amount of risk that you want to take. So what we're going to do is put some support and resistance lines on the chart. So we're going to use the trading view portion of the chart right here. There is an original here. This isn't good to use. Just use trading view. Trading view is great. It's industry standard. It's a completely separate site. I'll link them in the description. Trading view is the best trading charting software out there. It's completely free for the most part as well. It's really great. Gives you lots of different options, but you get it within MEXC anyway. So what we're going to do is look at support and resistance. So we're going to go over to the right hand corner, and put either a trend line on. I prefer a horizontal ray. So that is going to, you just click it here and it gives you a perfect horizontal line. So that's what we want. So as you can see, support and resistance method. Support and resistance is a price level where the trade gets to and bounces away from. Now to the downside, it's known as support, and to the upside, it's known as resistance. On a very long-term chart here, one-day chart, we can see right here is a support level for the price. On 3 occasions, it got supported here, but then broke down. But that doesn't matter. That becomes a support and resistance line. So that is a support and resistance line here from the previous bull market. Once, 3 times here, a couple of times here, a long bit of trade around this 30,000 level. You can see it's around 30,000 on the price. So that's the support and resistance level. That's very important. So I take my ray and I just draw that price line. Now, in the near term, what we can do is come down and get that support and resistance again. So what I want to look at here is after the price bounced up here, it got to this price level, got rejected off that. And then on the upside, you can see we met some resistance there again. We bounced through this line, down back through it, up again. So I want to have this area, it's not really a line, but more of an area around this price as a support and resistance level. That seems to me an important level. So it's around, let's call it 24,000, 25,000. You can have a box rather than a line. So this for me now is a resistance level to the upside and a support level to the downside for the current price. You can see we're now trading into this price again, meeting resistance as we get higher. Support and resistance levels, we can then use that to trade. Now it's up to us to figure out if we want to actually go long at resistance because we think we're going to break through, or we want to try and short this resistance and try and take profits down at this previous level of support and resistance. So that's very, very simple. There's a lot more to it. I've got some other more in-depth trading guides, which I'll link in the description, which are completely free. You can check out the crypto investor course as well, which has 300 videos on trading, private Discord groups. I'll link that in the description as well. But really the point of this is to give us some prices and some trade levels to make our trades at. So we've got that now, this one around 28,000, this one around 24,000. Now we can make some trades. As an example, let's go over to a lot size calculator for Bitcoin. And now we can see how much trade that we actually, or how much we want to trade with. So we can put the open price right here, which for right now is 27,900, 27,900 as a round number. Now you can put your stop loss in. Let's say we want to take a short position and we want to we think the price is going to come back down into this support. So what we want to do is a stop loss above the price if we're taking a short position. So if you're taking a long position, you'll lose when the price goes down. If you're taking a short position, you'll lose when the price goes up. So if we're taking a short position here at 27,900, let's say we want to look to take a loss if the price reaches around 30K. The reason, you can see that 30K is a very psychological level. You can see if it starts to break 30K from this support and resistance here, then it's probably it's because of a big upside move and we've taken the wrong position. So let's say 30K is a loss for us that we want to take, 30,000 like this. This works out if the stop loss is above or below, if you're taking a long or short position. Account balance is 1,000 and we want to risk 3% on this trade. Calculate, and you can see we can trade 0.0143 BTC. So now we know our position size. We can come back and take a short position here. We'll just do a market order. I'll change this to BTC from US dollar tether. It's up to you which one, but this has given us BTC here, 0.0143. So we know that's the position size, BTC 0.0143. That is the position size 143. That is the position size that we can take, given that we want to take 3% risk on a $1,000 portfolio. And then you can go ahead and enter that position. An important note on leverage as well is it just affects the amount that you put down into the position. So let me show you how that works. On MEXC, when you're entering orders, this is the order size and the actual size of what is traded in the market. But down here below the buttons where you actually open the trade is the actual cost of the order to your account. So keep that in mind. This is the order size that actually goes out into the market. We can see this because we're using isolated 3x margin right now. And you can see for this position, now I've just added an extra decimal here just to make it simpler. As you can see down here, the margin required for this position where we're trading 0.0014 BTC at 3x leverage is $13. Now, if I just take the isolated and change this to 5, do that, and then won't change the isolated 3x, you can see I now need much less capital down for that trade. So I can change this to 5x as well. And you can see that 13 now changes to $7.80. So all that you've done with increasing leverage is decrease the amount of margin that you need to put down to fund that position. What you've also done is brought up the liquidation price of your trade as well. And so you have to keep that in mind. So the more leverage does not change the trade size. You can, of course, change your trade size if you want to say, I want to use more margin and put the same amount down in my cost. So I can now change this, to maybe 0.0225, something like that. That brings me up to the same cost of my order, but you can see I've now used the margin to increase my actual trade size, but that does now put your money more at risk. You now have more at risk of your portfolio than you did before. So you can make, as a trader, that decision on what you want to do. Increase trade size, increase risk, or just put less down and have the money for other positions, or to have more flexibility later on in the order to either go more into the trade or not. Here's an example of a long order on MEXC. So we're going to go with the market order just to show you here. Market order, we're going to choose a quantity, and we're also going to choose margin here. So 0.002 BTC is about $55 with 2x leverage. You're looking to pay about $28 of margin here. Now what we're going to do is go long with a TPSL. TP is take profit stop loss. So again, it's using those trigger orders or the stop loss orders. So let's say we're going long at 27,900. We want to take profit at around 29K, just as if it's going to break out. So 29,000 would be a take profit, and the stop loss here again, if the trade moves against you, maybe to 27,300, like this, that would be your P&L. And now you can see the estimated P&L if you lost on that stop loss would be $1. So well within your limits in terms of getting stopped out or anything like that. So we're going to open long here, going to check the position, 2x leverage, going to click confirm. Now down here, you should be able to see the order. Now what you can see on the system as well is you can see your order. If we zoom in, you can see your live order, which is this green line. You can see the stop loss order, which is here, and then you can see the take profit order, which is here, those 3 dotted green lines. Now down here, we can see open positions, a 2x long position in Bitcoin, the position size, the entry, everything like that. We can see the margin ratio, very, very high, so no problems there. Now what we can do also is change the margin. So if you are making a loss and you think, actually, I didn't put enough margin down, press this here, and you can add more margin to that position. Now that obviously reduces your risk and moves away your liquidation price. That's if the position is moving against you and you want to put more margin in to fund that position because you actually want to let the trade run out. You can do that very easily. Add in, an amount that you want to add into the trade, and you can add collateral in there, and then liquidations move further away. You can also reduce it and take some equity out of the equation as well if you want. Press cancel on that. You can see the take profit and stop loss here. You need to just click on the 1 here. So TP1, if you just press this, you can now edit that. So you can edit the options here. If you want to move it around, you can do take profit. You can move away. You can even move the stop loss away, change it around any way that you want to make sure that you are taking the amount of risk that you want. So you can edit that order as is. And on the right hand side, you can close that. So what we can do actually is close a part of the order. So if we close long, it will give us the option to actually input an amount that we want to close in terms of the price, if we want to put in a limit order, or the amount of BTC or other crypto that we want to trade. So what we can do here is go up to the top right hand corner, and you can see close here. This is a close order, which means if you have an open position, you can close a portion of it. If you're open 1 BTC, you can close half of that BTC position, and whatever the P&L is at the current time, that will be worked out on that half a position. But down here, I think it's a little bit easier. So you can close a specific amount. You can see closable positions is 0.002 BTC. Do you want to close 25% or 50% of it? So this is often used when you're in a profit and you want to close part of the order to essentially just take some profits out and equity out of the equation. So you can close a small part of it. You can see here, I'm just going to instantly close this because we're in it's a tiny profit here, but instant close, that's basically a market order. Press confirm and it will get out of the whole thing for you. Again, that's a market order, so you'll pay some trading fees there, but that just gets out of the entire thing and closes off the order, whenever you press that button. An example of a short order as well, it's the exact opposite of a long, the way we think of it. So we're opening here a short. So we're going to go with 0.002 BTC, which is an order size of around $55. Then we're going to short here, TPSL. You want to go on the short side, otherwise it won't work. Take profit now is going to be lower than our entry. Let's choose 27,000 here. And our stop loss would be higher than our entry. Let's say a tight stop loss of 28,000. That's would be a small loss for us, and 27,000 the take profit, which would be an ROI of 6% here. So we're going to open that short, press confirm, and it's exactly the same here. You now have a short position in the market, and you see all the details here. You can change the take profit and stop loss as before, but you can instantly close this. So again, the take profit is just taking profits lower and a stop loss higher. Going to instantly close that, confirm, and then that's gone. If you want to trade on MEXC, the link is down in the description to a deposit bonus. The Crypto Investor course has 300 videos as well, that link down there. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.